Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
By the way, if I'm looking at this market possibly getting quiet here now, and one of the things Steve and I were talking about right before we started our presentation was, right now, I know there's a big boxing match this weekend. Is it this weekend? I think Manny Pacquiao is going to be fighting, Miguel Cotto, I think it is. But if you ask me, the two people that are duking out in the middle of the ring right now are the Dow and the dollar. Okay, that's a fight that I think everyone's watching right now, because we're watching this whole risk appetite, risk aversion play out right in the center of the ring as the dollar and the Dow do battle. Why does that matter to us as Forex traders or as Forex options traders? As an options trader, you are trading the stock of a country. Okay, so understanding what elements will affect the stock of a country is very important. And right now, with the risk aversion or the risk appetite that we're dealing with day to day, we're seeing either the Dow rally with risk appetite, or we're seeing the dollar rally with risk aversion. When people are frightened, they're going to the dollar. When people are feeling greedy, they're going for the equities. They're going for the higher return. And that, in turn, is affecting the relationship between the dollar and the other currencies. So when I take a look at the dollar being affected by a weak or strong Dow, okay, I know that's absolutely going to affect my EUU, okay? Or even, my Aussie, my cable, okay? It's going to affect my Swissy. So if I wanted to take advantage of a pair that also moves very much in sync with the dollar, I could take a look at that SFC symbol here, okay? So part of setting yourself up for these trades are not only understanding the market cycles within that pair, but what's going to affect it. What's affecting that pair? And more specifically, since the dollar is the common denominator, I don't care if it's the base currency or if it's the second currency, the one thing that every one of these symbols has in common when you're at the ISE website, the fxoptions.com website, is that it's some sort of relationship between another currency and the dollar. I don't care if it's the loonie and the dollar, or the sterling and the dollar, or the krona and the dollar, the franc and the dollar, the peso. You get my point. It's the relationship between another currency and the U.S. dollar. So understanding the dollar and Dow and the risk aversion, risk appetite discussion is very important. In fact, 9:30 every morning when the stock market opens has become, in many ways, an event every single day. I kind of look at economic events and I call them hot zones. When there's data coming out like non-farm payroll last week, last Friday. Well, every morning at 9:30 we've got almost, in a sense, an event, which is when the Dow opens and all that psychology floods the market for those first 20 minutes during the clearing, and we get a good idea of the risk aversion or risk appetite for the day, and it affects, of course, the dollar and our Forex. Okay, that's a higher volatility time. I'm usually not buying options between 9:30 and 10 a.m. I'll tell you that. I'm usually not buying my options there. I'm either buying before that, or I'm going to be buying sometime after that. But the volatility as brought on by the different events during the day are things you need to keep an eye on. Okay? So keep in mind how time will affect your pricing. Because our goal here as buyers of puts or buyers of calls is to pay as little as possible for volatility. Again, I want to take that money that I would typically allocate to volatility and give myself more time or a better strike. Is everyone with me so far? I'm going to take a look at the quote, the chart, the questions here. So just bear with me. right, so when the moving averages stretch out far apart, is that time to be fading or counter-trend trading? Thank you for your question. It's a great question. Two things about the three lines. They have to be put within their proper context. Okay? I think one of the bigger mistakes that new traders make, and I say new traders because I find that traders are like new drivers. New traders are like new drivers. When you first learned how to drive, you were probably really close to that steering wheel. That was your comfort level. I find new traders tend to look at the market a little too close up, just like a new driver would be clutching that steering wheel. Experienced drivers tend to kick way back, right, from that steering wheel, almost lay down practically sometimes when they're driving. I find experienced traders sometimes put way too much data on their charts, as if a bigger picture is going to give them a better look into the psychology of the market. I think there's actually a middle ground there. I think there's actually a psychological relevance to how much data we look at. Specific to the 240 daily, if I'm looking at a 240-minute chart, and this does have ramifications for the reading you will get on that 34 EMA wave. On a 240-minute chart, let's go at 240 right now, I'm usually looking at about 4 to 6 weeks, because a 240-minute chart is still an intraday time frame. The highs, the lows, the last major moves, they typically don't have a lasting impression beyond about 4 to 6 weeks. If I asked you what a trend was on a 240-minute chart, or a trend on any market, you're probably not going to remember that far back beyond a month, intraday. End of day, that's a completely different discussion. But intraday, about 4 to 6 weeks. If you get closer to about 8, that's fine. But on a 240-minute chart, you're going to find yourself looking to gauge the angle of the three moving averages, to take a look at the last major moves across a 4 to 6, maybe 8-week view. This is about the end of September. So I've got October and a little bit of November. So this is about that 4-week view. Okay, if you squeeze in a little bit more, that's fine. Don't get hung up on exact 4 to 6 reading. Just realize that you need to look at a healthy amount of data, but not too much. Again, 4 to 6 weeks, so that 240 will work. And that will put that study, the three moving averages, in the proper perspective in terms of their angle. For a daily chart, to me, you really want that year. Okay, 52-week highs and lows matter. The trend over the last 6 months, 3 months, the trend over the last year, the highs and lows over 1 year, the 50 matter. So you're going to be looking at 1 year on that daily chart. Okay, and that's the perspective from which you'll look at the way as well. In fact, whether I was looking at it within that little zoomed-in view or whether I look at it within that 1 year, you can still see right about here that market is trying to quiet down a little bit. So there's that 1 year view. Okay? Well, actually, that's more than 1 year. There we go. That's even more than 1 year. There we go. That's even more than 1 year there, too. So you can see you don't need that much data, but you can see here it's starting to transition. 1 year, okay? So first of all, you want the right perspective, okay? As far as the lines widening or narrowing, that's going to be a reflection of the range between high and low. And certainly when they widen, that just tells you that the range between the high and low, even within a trend, is increasing. But I don't really look at the width as much. These aren't like Bollinger Bands, okay? I know a lot of people would look at that kind of thing with, say, a Bollinger Band, but that's really not. You're looking more at the angulation. And the other thing you're really keying in on is when the prices are trending and they correct, are they correcting and keeping support within an uptrend within the wave? Or when they correct, is the wave able to keep them contained within the downtrend? So in an uptrend, is the wave support, and in the downtrend is the wave resistance. And the more that it is, you'll see that it is very often. The more that it is, the more you can trust it. Okay? And that's when they're trending up or down. All right, so thank you for that question.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcast.